One of the investments I am most proud of in 84 years of building Berkshire Hathaway is a company most people know primarily for selling car insurance, GEICO. I first became interested in it in 1951, at 20 years old, because of a single insight that I have never forgotten. GEICO's entire competitive advantage was the elimination of an intermediary. Traditional car insurance was sold through agents. Agents added cost. GEICO sold directly to the customer. No agent, no commission, no markup for having someone in the middle. The savings passed through to the customer, cut out the middleman, pass the savings through, and build a durable business on the structural advantage that creates. I have thought about that principle for 75 years, and every time I look at the savings account industry, I see the same dynamic playing out in reverse. The bank is the intermediary. The depositor is paying for the privilege of having a middleman between their cash and instruments that cash could access directly, and the cost of that intermediary, paid invisibly every year by tens of millions of savers, is one of the most consistent transfers of wealth from individuals to institutions in the American financial system. Let me show you exactly what that looks like and why it matters for Carol. Carol is 46 years old. She is a human resources manager at a manufacturing company in Minneapolis, Minnesota, earning approximately $82,000 a year. 2 years ago, she did something most people in her position never do. She moved her $25,000 emergency fund from a traditional savings account paying 0.4% into a high-yield savings account paying 4.5%. She read the articles, compared the rates, made the switch, and felt, correctly, like she had made a better decision than most people around her. Carol is right. She is ahead of most savers, and she is still paying an intermediary she does not need to pay. Not because her high-yield account is a bad product, but because she does not yet know what her bank does with her $25,000 the moment she deposits it. Subscribe and turn on the bell before we go further. What I'm about to show you is the same insight that drove one of the best investments of my career, applied to the idle cash sitting in Carol's account right now. Here is what Carol's bank actually does with her deposit. The moment Carol's $25,000 lands in her account, the bank puts it to work, not for Carol, but for the bank. The business model of every commercial bank in America is built on one mechanism: borrow from depositors at a low rate, deploy that money at a higher rate, keep the difference. The average net interest margin for U.S. banks in 2026 is approximately 3.3 to 3.5%. That is the spread the bank extracts from deposits like Carol's every single year. In specific numbers, Carol's high-yield account pays her 4.5% on $25,000, approximately $1,125 annually. One of the primary things her bank does with that deposit is purchase short-term U.S. Treasury bills. 3-month Treasury bills currently yield approximately 3.6 to 4%. The bank buys those treasuries with Carol's money, earns roughly 4%, and pays Carol 4.5. In this narrow comparison, Carol appears to receive more than the Treasury yield, but here is where the real picture emerges. Carol's 4.5% is not a guaranteed rate. It is an advertised rate her bank can change at any time without her consent. When the Federal Reserve cut rates in late 2024 and into 2025, high-yield savings rates across the industry fell by as much as 100 basis points within weeks. Banks adjusted instantly. Depositors noticed when the statement arrived. Carol's 4.5% today may be 3% in 6 months, requiring no action from the bank beyond a notification email. The bank also lends Carol's deposit. Credit card rates are currently averaging approximately 21%. Auto loans run 7 to 8%. Mortgages approximately 6.5 to 7%. Personal loans around 12%. Every one of these products is funded in part by deposits from customers like Carol. The bank pays Carol 4.5% to borrow her money, then lends portions of that same money at rates between 7 and 21%. The spread, sometimes 15 or 16 percentage points on a single instrument, is the bank's profit on Carol's deposit. This is not fraud. This is the explicitly stated business model of commercial banking, operating exactly as designed. And here is the question Carol never thought to ask. If her bank is using her money to buy treasury bills, instruments Carol could purchase directly, why is Carol paying the bank to be in the middle? The answer is that Carol did not know the direct path existed. Most savers do not, and that is the bank's structural advantage. Not that it offers something Carol cannot access, but that it benefits from Carol not knowing she can access it herself. There are two practical ways Carol can eliminate the middleman. I want to be specific because principles without mechanics are worth very little. The first is treasurydirect.gov, the US government's own platform for buying treasury bills directly. Carol creates an account, links her checking account, and participates in treasury auctions. When her T-bill matures, principal plus interest returns to her checking account. There is no expense ratio, no bank margin, no intermediary of any kind. The limitation is that T-bills have fixed maturities, 4 weeks, 8 weeks, 13 weeks, up to 52 weeks. For an emergency fund, Carol can manage this by staggering purchases across different maturities, so a portion becomes available each month. The second is a Treasury ETF, a fund like ESGov, which holds only short-term U.S. Treasury securities and currently carries a 30-day SEC yield of approximately 3.5 to 3.6%. Carol buys it through any brokerage account she already has, Fidelity, Schwab, Vanguard, or any other, exactly like buying a share of stock. The price stays near $100. When she needs her money, she sells, with settlement in 1 to 2 business days. The expense ratio is 9 basis points, 9 cents per $100 invested, compared to the several hundred basis points her bank extracts through its lending margin. And, critically, interest from U.S. Treasury securities is exempt from state and local income taxes under federal law. Carol, as a Minnesota resident paying state income tax of approximately 5.35%, avoids that tax entirely on Treasury income, a meaningful difference on $1,100+ of annual interest. The most common objection at this point is FDIC insurance. Carol's savings account is insured by the federal government up to $250,000. A Treasury bill is not FDIC insured. This is true and practically irrelevant for a reason worth understanding carefully. FDIC insurance protects Carol against her bank failing. The guarantee behind that protection is the United States federal government. The guarantee behind a Treasury bill is the United States federal government, the same entity, applied directly rather than through a bank intermediary. Carol is not choosing between something government-backed and something uninsured. She is choosing between lending to a bank, which the government will rescue if it fails, versus lending directly to the government itself. In terms of credit risk, a U.S. Treasury obligation is at least as secure as an FDIC-insured deposit, and arguably more direct because the counterparty is the currency issuer rather than a private institution that requires a government guarantee to be made whole. I am not suggesting Carol close her bank account. She needs checking for daily spending, payroll, bills, routine transactions. That serves a genuine purpose. What I am suggesting is that Carol stop paying the bank to act as a middleman between her idle savings and the Treasury market the bank uses her money to access. Keep $10,000 in the high-yield savings account for genuine immediate access needs. Move $15,000 directly into Treasury bills, through Treasury Direct or through a Treasury ETF in a brokerage account she likely already has. The yield difference is not dramatic, but the principle is Carol is paying the bank for intermediation she does not need, and the alternative requires one afternoon to set up. Let me come back to Carol one final time. In the first version of her future, Carol keeps her $25,000 in the high-yield account. Over the next 18 months, the rate drifts from 4.5 to 3.2 as rates adjust. She notices when the statement is smaller than expected, investigates, and moves her money. Having paid several months of unnecessary intermediary cost, she will never recover. In the second version, Carol moves a portion of her emergency fund to Treasury Direct or to a Treasury ETF through her existing brokerage. She earns approximately the same yield or slightly less, eliminates her Minnesota state tax liability on that portion, removes the rate change risk, and, Most importantly, understand something she did not understand before. The bank was charging her for access to something she could reach herself. Every financial decision she makes about idle cash from this point forward is informed by that knowledge. GEICO did not become one of the most profitable insurance companies in America by offering marginally better coverage. It became exceptional by removing a cost that added nothing. Your bank's yield advantage over Treasury Direct is smaller than the margin it earns for being in the middle. The math has always favored going direct. Now you know how. Subscribe to this channel and ring the bell. The next video walks through building a Treasury bill ladder step by step, the specific process that keeps a portion of your emergency fund accessible every month without ever being fully locked up. Subscribe so you do not miss it. This content is produced with the assistance of artificial intelligence for educational purposes only. Nothing here constitutes personalized financial advice. Consult a qualified financial professional before making any investment decisions.